Well, good morning, everybody. Now, economists, of course, are renowned for their flexibility, their innate ability to prove that black is in fact white, and also renowned for having at least two views on everything. So given that sort of backdrop, I always like to start these talks with our disclaimer. There it is. I'll give you a moment to appreciate its full beauty. But moving right along, certainly some of that flexibility has been in evidence in recent months. A spate of disasters, natural and otherwise, has dented some of that optimism that was around about the economic outlook at the start of this year. So I want to start today with some of the reasons why the outlook for Australia is still pretty good, and why the outlook for the mining sector in particular is excellent. Indeed, what gives me a degree of optimism about the Australian economic story is that I think a lot of it is pretty much locked in. And this set of charts here shows why. In fact, somebody once described this set to me as Australia's two-fingered salute to the rest of the world. I'll leave you to work out why. But what it says, the chart on the left-hand side here, our terms of trade, something Australian economists talk about endlessly these days. Well, the important point about that chart is every time that red line goes up, what's happening is there's a transfer of income going on from the rest of the world to Australia. That income transfer is enormous. It is supporting a lot of spending and economic activity in the Australian economy. Of course, tied in with that is a massive capital spending boom. And the chart on the right-hand side here shows you the value of projects that are underway at the moment. And what characterises this stockpile of projects, which is at record highs, is that most of it's in multi-year projects that have started. Because they've started, they'll go through to completion. Because they're multi-year projects, they're going to impact on the economy over a number of years. And of course, this CapEx boom, it's not new, it's been underway for a while. So some of those earlier projects are now actually at the point where they're starting up production, generating exports. And if you put these three things together, the income flow, the capital spending boom and this export response, there's enough there to give you something like 3 to 3.5% growth on average in the Australian economy over the next few years. Now that's an average result by our standards. It's not going to stand out the way it has in the past, because a lot of countries will be turning in average performances over the next couple of years, we think. But nevertheless, it's going to be a pretty good result given some of the headwinds that are at work. Well, economists talk endlessly about our terms of trade, and of course I've already mentioned it. Higher terms of trade is really the key outcome of this whole China-driven commodity story that's important for all of us. So I thought I might just say a little about what it actually is. Well, if you pull out your economics textbooks, it'll tell you that our terms of trade is the ratio of our export prices to import prices. I normally find at this point people's eyes start to glaze over because it's really only something that an economist could get excited about. But why do we get excited? Well, this chart here I think makes the point. What it shows you, the blue bar on the left-hand side there, it shows you the increase in production per person over the last 12 years, which is sort of the period where this whole China story has really got up and running. Well, that increase in production per person is about $11,000 over that 12-year period. But if you look at the green bar next to it, which shows you the income generated by that production, it's actually increased by $17,000 over that period. Now, that's very unusual because normally income per production grow at about the same rate. That $6,000 gap is a measure of the extra spending power that everybody has per person per annum, courtesy of what we've seen in this China-driven commodity story so far. It explains why, when you look back over the last 12 years, we've had various shocks that have hit the economy. Many of them were expected to push us into recession, but this continued income flow, I think, allowed us to sort of bounce through those potholes and come out the other side in pretty good shape. Perhaps just to put one other sort of slant on this, the Governor of the Reserve Bank, Glenn Stevens, he had probably the best quote I've heard so far about how this terms of trade story is playing out for Australia. He made the point that 5 years ago, every boatload of iron ore we sent to China, we got 2,200 big screen TVs back the other way. Now that same boatload will now buy 22,000 big screen TVs. So it just gives, again, an indication of how important this terms of trade story is for Australia. Of course, there's always this worry that it's all too good to last, and One of the rules economists learn early on is that what goes up must come down eventually. And that's certainly been true for terms of trade cycles in Australia. The chart on the left-hand side here, it shows you all of the terms of trade cycles that we've had since the late 1950s. There's been quite a few, but what you notice about those lines is that every run-up has been followed by a run-down. That's pretty much leaves us where we started initially. Will this time be different? Of course, that historical experience explains why Australian commodity forecasters always want to forecast price falls. And the chart on the right-hand side here shows you the history of Australian commodity price forecasts over the last 7 years or so. So each of those little coloured squiggles there is the average forecast of Australian commodity price forecasters at various points in time, with the red line on the top there being the latest forecasts from last month. And if you look at that chart, there is this pretty persistent theme, and that is the next big move in prices is going to be down. Well, another rule economists learn early on is never change a good forecast because it'll be right eventually. But I want to suggest that, in fact, this time is different. Now, this chart here just updates that terms of trade cycle chart. I've added on the red line, which is what's happening this time. I don't actually need to ask the question, is this time different? Because clearly it already is. The terms of trade story this time has run much further and much longer than any of those previous cycles had. And I think what this highlights is that the increase we've seen in our terms of trade, or commodity prices if you prefer to think about it that way, is in fact a permanent structural feature of the landscape. Now, there's still going to be a cycle in commodity prices. They'll still go up and down, but I think it'll be around a higher average level than in the past. So what might drive that cycle in commodity prices? Well, when I speak to our commodity team at the Commonwealth Bank, the thing that worries them the most, of course, is the potential for supply to rise. There is this massive capital spending boom rolling through the Australian economy. There will be a big increase in production here. And of course, that's not just an Australian story. Pretty much every mining country is doing the same thing. So there will be a lot of extra supply coming on stream over the next few years, and that does have the potential to drive price falls at some point. But what that argument misses, I think, is the fact that we actually need an increase in supply to keep up with the increase in demand that's coming through, let alone get ahead of demand to produce this price fall that commodity price forecasters always worry about. And this next chart here looks at the next 5 years and looks at projections for demand for various commodities and compares those projections with increases in supply in those same commodities. And basically, if the bars there are negative, which they are for many key commodities, what it implies is the increase in supply is not actually keeping up with the projected increase in demand. So it suggests that it's not so much the supply side of the story that may produce this price collapse that we always worry about. Instead, we probably should be more concerned about what happens to the demand side of the equation. Well, of course, as I mentioned at the start, since the beginning of this year, we've seen a range of floods, earthquakes, tsunamis, and so on that certainly have the potential to dent the demand side of the commodity story here. All of these events are what economists call black swan events, and what they mean by that is they're events that were unexpected and events that potentially could have a big impact on the economy. Now, natural disasters are in fact not rare events, and much to my surprise, there are people and organisations that collect statistics on natural disasters, and then there are people like me who take those statistics and turn it into a chart, which is what I've done here. And what it shows you is the economic damage done by economic disasters, or natural disasters rather, and we have something like 350 to 500 of them around the world every year. And this chart just gives you the history of the economic damage caused by those disasters. On average, it works out at around about 0.2% of global GDP over the 30 years or so that I've got the data on the chart there. And because they're not rare events, it explains why there's actually no correlation at all between these events and even the bigger ones and what happens to global growth. I think it also highlights the point that the rebuilding effort after these natural disasters tends to fill in whatever hole in demand might actually come through at the time of those disasters. Now, certainly the terrible events in Japan are going to be one of those big ones. When we get the data for this year, I'm sure it'll be one of the bigger red bars on this chart. But nevertheless, the global backdrop is still one where we're going to see above-trend growth and one that's pretty supportive for the commodity story overall. The bigger demand-side risk, I think, really is the fact that we're seeing in China at the moment something of a shift from pro-growth policies to anti-inflation policies. Now, they're starting to tighten up their policy settings there, and like all policymakers, when they start on these adventures, their aim is never to crush the economy. They're always looking for that sort of mythical soft landing, and of course there is a risk that they do go too far and that we get a bigger slowdown in the Chinese economy that does really then dent the demand side of the commodity price story for us. We think, however, that the Chinese authorities have actually done enough to deal with the inflation problems that they're dealing with at the moment. And if that's true, then the backdrop for commodities still looks pretty good. And I say that based on this set of charts here. When you think about economic policy in China, it's different from Australia. It's not interest rates that matter, because they essentially have a fixed exchange rate. They can't really do much with interest rates. Instead, the better policy indicator to look at is something they call their reserves requirement ratio. And the blue line on both of these charts shows you what's happening with that ratio. Plotted upside down, so as that blue line falls, what it means is policy is being tightened, and it obviously has quite a long way. But why it's important for this story is that with the lead of about a year or so, that particular policy indicator has been pretty good at showing you the direction of the Chinese inflation story, the green line on the left-hand side there. And it certainly implies quite a big slowdown in inflation in China over the next year, and hence not much need to do much more on the policy front. And you translate over that to the right-hand side chart there, where the red line in that case is Chinese steel production, which I've added on as an indicator for Chinese commodity demand. Well, what it suggests is that sort of commodity demand indicator is remaining at very high levels. It's a backdrop that's still favourable to the Australian commodity price story overall. Well, the resources story, of course, has some other implications and risks for the Australian story more broadly. One of those implications is that we're looking at what is probably the most construction-intensive period in Australian economic history. It's more than just the mining story that we all know about. There's also a huge increase in spending on infrastructure underway. We have seen a lift in residential construction activity. Parts of the non-residential story are also starting to pick up. And of course, over the top of all of this, we're now laying this rebuilding effort in Queensland and elsewhere. So one of the questions we've been grappling with is, well, is there actually enough materials and labour around to allow all forms of construction activity to charge ahead at the same time? And the risk is probably not. And this chart here, I think, highlights the point. What it shows you on the bottom axis there is the share of our workforce that's engaged in construction activity. And then the vertical axis shows you the real wages that are paid to construction workers. And there does appear to be a wall that we hit, that when we've got somewhere between 9 and 10% of our labour force employed in construction, it's always proved impossible in the past to get more workers into that sector. And what you tend to see happen instead is that wages or inflation pressures lift in the economy. And what we're seeing at the moment certainly fits in with that idea. It is one of the indications of the broader inflation pressures running through the Australian economy. It is one of the reasons why our central bank, the Reserve Bank, looks like it's set to raise interest rates again. One of the other risks comes from the fact that we're trying to allow this massive mining boom roll through an economy that's pretty much running at full employment right at the moment. And some of the problems that you can see from that I've tried to highlight on the chart here. That purple line, it shows you a survey of all the value of resource projects and other projects that are under consideration. So they haven't started, they haven't been approved, they're on the board table for discussion right at the moment and may get underway over the next few years. Well, you can see the huge run-up in that indicator. And the reason I look at it is because it's been a pretty good indicator of where the investment share of GDP, the brown line on that chart, goes over time. And what it implies is that investment share is likely to increase by 5 or 6 percentage points over the next few years. Now, if that happens, that's a massive restructuring of the Australian economy. It's only going to be possible if some other sectors make way. So it is one of the reasons why we're very keen to see the budget get back into surplus as quickly as possible. But in the end, the only sector big enough to make room is the household sector. Of course, when you're thinking about how do you get the household sector to make room, well, putting up interest rates is a pretty effective way of squeezing household activity. So what we have in Australia at the moment, I think, is, if you like, a set of traditional reasons, inflation reasons to raise interest rates, but also this resource allocation story that points in the same direction. It's one of the reasons we think we will actually see quite a significant lift in interest rates over the next 12 months. In fact, we've got rates going up by a full percentage point over that period. Now, because, of course, this is a very capital-intensive story, it does come with a large financing requirement as well. So, again, one of the risks that we've been thinking about is whether that finance will be available or not. Now, a lot of this, again, is a mining story, and cash flows are pretty good, so that will account for a fair chunk of the financing task, but it won't be enough overall. But right at the moment, though, we think the global backdrop looks pretty good from that financing perspective, and it reflects the very significant actions that central banks around the world have taken to try and keep the financial system going, try and prop up their economies. I've tried to pull out some of the key features on this set of charts here. Now, what's happened around the world is the major central banks, like the Fed in the US, the Bank of England, the European Central Bank, they have massively expanded their balance sheets. And the first panel on this chart shows you how their balance sheets have grown. They've more than doubled or tripled in some cases. And what that means is they've actually flooded the global financial system with liquidity. What they've also done, as the middle panel shows, is they've taken actions to reduce interest rates, which are very, very low as well. So what we have from that financing perspective is a situation where there's plenty of liquidity and it's available quite cheaply. Now, if you put that together with the final panel, and what that shows you is something called the VIX index. And what this really is, or the way to think about this, is it's a measure of risk appetite. The lower that green line is, the more appetite there is amongst investors to take on risk. And right at the moment, that sort of risk indicator is at pretty good levels. So we've got a indication again where lots of liquidity, it's available cheaply, and there is a lot of risk appetite out there amongst investors. So it's actually a very favourable backdrop for many corporates in terms of raising finance. We don't think that financial constraint will impact on the CapEx story here. Now this whole process is something that has been called quantitative easing, or QE for short, and it does have some implications and risks for the commodity price story as well that are worthwhile thinking about. This chart here, it's just a variation on the theme. In this case, I've just looked at the US. So the blue line there, again, what's happening with the Fed's balance sheet in the United States, that massive expansion, that massive liquidity. At a time when you look at the red line, well, they've cut interest rates in the US to near zero. So you can sort of see the way those jaws have opened up. Now, it does look like some of that cheap liquidity has been finding its way into commodity markets. And the other two lines on that chart show you what's been happening with the gold price and the CRB index, or just an average index of global commodity prices. So these sort of financing conditions, policy conditions around the world do look to have added a speculative element to the commodity price story right at the moment. So, of course, there is a risk that when central banks start to take back some of that liquidity, when they start to raise interest rates, that it will impact on commodity prices as well. So certainly something to look out for in your own planning. Now, while I've focused on the short term here, there is also a longer run story that we shouldn't lose sight of. Now, I like long run charts, and They don't come much longer than this one. What it shows you is the share of China in the world economy over the last 1,000 years or so. And what it implies is that normally China accounts for something like 20-25% of global economic activity. It does suggest that the very strong growth in China that we've seen over the last 20 years is really just confirmation the recession of the previous 200 years has come to an end. But the point, though, really with this chart, of course, is that if China is going back to anything like its long-run average share of global activity, then it's going to be a very different global economy that we'll all be operating in over time. And the points that I think are most interested in this story, and certainly what excites our commodity strategists the most, is the fact that rapid economic growth in China is flowing through now to incomes. And that income growth is going to shift Chinese economic drivers over time. In fact, income levels in China are approaching the point where historically the consumer takes over as the key driver of growth. Now, we saw this happen in Western Europe in the 1950s. We think we're going to see the same thing happen in China from here. And the chart on the left-hand side here tries to make the point. What it shows you is income levels along the bottom axis and vehicle ownership as a proxy for consumer spending, mainly because it's the easiest data to get. And it shows you how that sort of income-consumption relationship has changed for a range of countries over time. Well, you can join up the dots and get a curve out of that, but what it implies is the period of rapid acceleration in this consumer story gets underway when incomes get to about $5,000 to $10,000 US. Now, incomes in China are rapidly approaching that point. What it says is the Chinese economy will continue to grow very strongly, I think, but it will be a different type of growth, and we need to be ready for that shift. Well, how we fare against that backdrop will depend on how we adapt to these changes. And it is important to remember that there are some offsets here that are going to be very important to the Australian economy beyond just the commodity price implications of this. One of the standouts there, I think, is demographics. The fact is the world's middle-income population is going to increase significantly over the next 20 years. And the chart on the right-hand side shows you some of the demographic projections that have been produced on this issue. And the biggest increase in that middle-income population is going to be in the East Asian region, and of course that's the region that's most important for us. It's going to be part of that shift to the consumer side of the story that I've mentioned earlier. And what do we know about that? Well, these are people who are going to want to eat more. They're going to want to have better quality food. They want to have better quality housing. They want more consumer durables. They want access to education services. And of course, like everybody else, they're going to want to go on holidays. So there's a lot of offsets here for other parts of the Australian economy that may be not doing so well at the moment, courtesy of the currency, which in turn is another part of the commodity price story. Now, the China story, the commodity story, it already has had a lot of significant impacts on the Australian economy more broadly. And in fact, I think they have the potential to quite dramatically change the economic landscape over time. And I picked out just part of that story with this chart here. What it shows you is courtesy of that capital spending boom I keep talking about, the investment share of GDP in Australia, the brown line there. It's already at record highs. It's only likely to increase further from here. And that's occurring at a time when, until at least very recently, our population has also been growing very, very rapidly. The green line on that particular chart. The fact that investment share of GDP, that sort of population growth rate we were seeing, they were the sort of numbers you'd expect to see in developing economies, not one like Australia. But if after you've finished checking your economics textbooks about the terms of trade, if you flick forward, you'll see another chapter that tells you what determines how fast an economy can grow is two things: the size of its capital stock and its supply of labour. Now, what we're seeing at the moment, and what I think we'll continue to see over the next few years, is that our economy is having a lot more capital injected into it, a lot more labour supply as well. And what that suggests is that the potential growth rate of the Australian economy is in fact going to step up over the next few years. Based on the calculations we've done, we think we'll see our average growth rate step up from around about 3.25% a year to about 3.75%. Now, that might not sound like very much, But if you accumulate that up over the next 40 years, what it implies is the Australian economy will be 2.5 times bigger than it is today. So not only will it be a bigger economy than we thought likely only a few years ago, it's going to have more people in it, and it's going to have much higher income levels as well. So vastly different economic backdrop from what we're seeing at the moment. Now, higher potential growth rate also has some implications for financial market settings. What it implies is that, on average, interest rates will be higher than they will be otherwise, and on average, the exchange rate will be higher than it would have been otherwise. So certainly in our longer-run planning, we need to be prepared for those two longer-running differences in the economy. Now, these shifts look largely unavoidable. They will be comfortable for some, but obviously they will be uncomfortable for other parts of the economy. I'll finish on that thought, but I feel I should show you our disclaimer again, which you'll now see covers 2 pages rather than the one that I started with. Thank you very much for your time today.
Thanks very much, Michael. That was great. I'll now ask Mike Rosenstreich from Bass Metals to come and give us a talk. Thanks.
Good morning. I'd like to introduce Bass Metals, a polymetallic producer and explorer. There's several key messages I'd like you to walk out of the room with. We've got a resource, a JORC-compliant resource of 2 million ounces gold equivalent. That's gold and silver. We've got 3 million tonnes of copper, lead, zinc, silver, gold, massive volcanogenic, massive sulphide resources as well. We have production from our underground Fosse mine. We produce lead, zinc, copper, silver, gold, concentrates, and we've got tremendous exploration upside because we're operating in the highly mineralised west coast of Tasmania. And to bring all of that together, we've got a highly motivated, highly skilled team of people. The company listed on the ASX in October of 2005. Today we have 213 million shares on issue, trading at a disappointing 28 cents to give us a market cap of around $60 to $65 million. That's a picture of our chairman, the Minister of Mines, Brian Green, and myself doing the obligatory unveiling of a commemorative plaque to commemorate the opening of our Helia mine project. This is the production part of the business. That's an aerial shot looking down over the Helia mill in the middle there. You can see the railway and the road going into the mill site, and that linear feature going to the horizon is a regional power line. Our Fosse mine is shown beneath the surface there around that orange orb, and there's about 1 kilometre of decline access into it. You can see here I've highlighted some other resource areas. You can see the Kew River resource about 4 kilometres to the south, the Helia resource immediately north of Fosse. So the Helia mine project is a 5-year mining plan, where in the first 3 years we plan to mine copper, lead, zinc, silver, gold ore from the Fosse area, and in the following 2 years to pull resources to pull ore from the Kew River and Helia resources and process all of those in that centrally located Helia mill. Just to give you a quick snapshot of the project, Fosse is a resource that we discovered in 2007. It's a fairly simple underground mine, about 200 metres beneath the surface. We're mining around 450 to 500,000 tonnes of ore a year, and we do that in an alliance structure with our partner Mancala. We own a 1.5 million tonne per annum modern, built-for-purpose flotation concentrator plant, the Helia mill. It's currently in ramp-up phase. You can see a couple of shots there with people in it. This is a big facility, and we mine continuously, but because of the size of the mill and our production rate, we mill on a campaign basis, approximately 4 weeks on, 4 weeks off. Here's a shot of 3 happy gentlemen standing in front of the initial zinc concentrate pile. In terms of the products we make, or we're planning to make, or we're ramping up to make, around 50 to 55,000 tonnes of good zinc concentrate, around 27,000 tonnes a year of good lead concentrate, and around 5,000 tonnes a year of a copper precious metals concentrate. Our customers for that product is Nearstar. They take the zinc into their Risdon smelter, they take the lead to Port Pirie, and the precious metals copper concentrate we sell overseas through Allen Metals. We're forecasting a pretty low operating cost if we use a C1 cost per pound of payable zinc around about 15 cents. So that puts us well into the lowest cost quartile. So just to summarise that production scenario, we're talking about a 5-year mine plan. We have 2 years of reserves at the Fosse. We think we can extend that for at least another year from the resources that we've outlined around that Fosse mine, and then we will go to the Hellier and Kew River resources. As I said, we're currently in a ramp-up phase, and I have to admit it's been with its challenges. Significant dewatering issues in our underground mine. We're pumping something like 60 litres a second out of that, which you'll appreciate is a high rate. We've had some issues getting the mill up and running on a campaign basis. But as of Monday, we started our 4th and largest milling campaign, and we're very confident we're getting well and truly on top of those. We've made the necessary modifications, and we're looking forward to progressing that in a really positive manner. We have to celebrate successes, and given those challenges, I think we need to celebrate the aspect that we have an outstanding safety record. We've had no LTIs in any of our mining operations, either open pit or the Fosse underground, since we've started. So that's a real credit to the team on site. Another aspect of the company is exploration growth. As I said, we operate on the west coast of Tasmania, and if you can see that map, you'd see world-famous names like Rosebery, Hellier, Kew River, Mount Lyell, Henty. These are large-scale, high-grade, polymetallic deposits, and they characterise the neighbourhood in which we explore. We've got a track record of exploration success, and one of our most highly prospective areas is in the Hellier-Kew River area. This is a plan showing the Hellier and Kew River mining licences. You can see the mill in the middle of the Hellier, Kew River and Fosse deposits. We are effectively exploring in the shadow of the mill. If we have modest success, we can hopefully cash it in. If we have outstanding success, we have an empty or an underutilised 1.5 million tonne plant to utilise for that. How is it that we can have exploration success in an area which a lot of people would have considered to be well explored? If you look at this long section of the Hellier deposit, there's the Hellier mining area. That was 16 million tonnes of production from 1988 to 2000. There's our new Fosse discovery. We discovered Fosse in 2007 and then extension last year. About 3 million tonnes of mineralisation. How can this happen? They're only 150 metres apart. Let me give you some insight. That's a cross-section through the Fosse deposit. And traditionally, the exploration target, not only at Hellier and Kew River, but indeed throughout the Mount Reid volcanics, is to explore the interface or the Holy Host horizon immediately beneath the Hellier basalt. There's a really marked change in alteration beneath the Hellier basalt, and that's the target for the last 30 to 40 years of exploration people have been testing with drilling. I'd call that the traditional target. You can see in the blue circle there that Fosse and Fosse East occur significantly deeper than that traditional target zone. Let's call it the unorthodox ore position. And what the identification of this unorthodox ore position does is it opens up huge areas of prospective stratigraphy that have been drilled before but haven't tested those deeper extents for mineralisation. This has really opened up the exploration potential not only of the Hellier-Kew River area, but as far as I'm concerned, of the entire Mount Reid volcanics. So the outlook for our near-term outlook for our exploration activity is to continue to test for extensions around that Fosse area. We have mining infrastructure going into it, and so that's an area that we want to utilise more fully. If you have more questions on our exploration activities, please speak to Kim Denwer, our exploration manager, in our booth. The final aspect of the business is our gold resource that I mentioned earlier. It's a resource contained within the Hellier Tails Dam, which you have an aerial shot of here. You can see it's close to the Hellier Mill. There's 10 million tonnes of material in there. It's grading about 6% lead and zinc, 2.5 grams gold and 100 grams silver. It's a gold equivalent grade of around 4.9 grams. A lot of people's eyes glaze over when you talk to them about tailings. These are not tailings that were generated in Roman times. These are tailings that are modern, they've got good records, and we have a pretty good understanding of what's there. The challenge of this particular project is to get the processing technology right. And in our recently completed scoping study, which we're moving into feasibility, we're actually relied in that study on detailed feasibility study level test work to give us our assumptions. The test work that we've been reporting on recently, which we hope to have complete before the end of June, is indicating that pressure oxidation is a preferred processing route. We think we can be making about 80,000 ounces of gold equivalent per year at an operating cost of around $550 an ounce, after having spent around about $120 million in capital. There are technical advantages or advances since the late 1990s that we hope to bring into that scenario, which could see that improve. It's subject to a feasibility study that's happening now. But I argue very strongly that it is a realistic and sensible project. The technology was proven in the 90s. The thing that has changed is metal prices. So just to wrap up, what you've seen is a presentation on a company that's in production. It's production of copper, lead, zinc, silver and gold at a meaningful scale. You've heard about a company that's very active in an exploration sense in a highly endowed part of the world and has had exploration success to date and will continue to do so. And we've got a large-scale gold project that we're in a feasibility study and I think has a realistic chance of coming into production. Thank you.
Thanks very much, Mike. I now call upon Louw Smith from Ascouugh to give us a presentation. Thank you.
Thank you, Mr. Chairman. Ladies and gentlemen, good morning. Thank you for the opportunity to present. My main focus this morning will be on introducing Ascouugh to you. Today, Ascouugh is the second largest gold producer listed on the ASX with a market cap of 2.5 billion Australian dollars. Ascouugh was formed only 3 months ago on the 18th of February through the successful merger of equals of Avoca Resources, a ASX-listed Western Australian gold producer, and Anatolia Minerals, a TSX-listed Denver head office explorer with developing projects in Turkey. Our cautionary statement, I will provide some forward-looking information, so would like to careful consideration with the information we'll provide. Ascouugh plans to produce 400,000 ounces in 2011. The 135,000 ounces will come from the Anatolia Çöpler gold mine in Turkey in its first year of gold production. The balance of the ounces will come from the Avoca operations in the eastern goldfields near Kalgoorlie. Cash operating costs at the time that we announced the merger was between $400 and $450 per ounce. However, 6-7 months later, we're now looking at $590 per ounce. This is reporting in US dollars. The key drivers for that step up is in the much stronger Australian dollar, 4% reduction in gold outlook, aligning accounting policies, and then inflationary contributions, fuel, energy costs, and wages. In the couple of months, 3 months that we've been together, we've increased reserves from 3.3 million ounces to 5.5 million ounces. We've set ourselves a resource target of 15 million ounces this year, and by 2015, this company would like to produce 800,000 ounces. The next couple of slides will talk to mainly two step change organic growth projects that Ascouugh has identified as part of the merger. We use this slide to explain our capital structure. There's a lot of information contained in this slide. However, I would like to refer to two things. Firstly, both these companies come from a rapid growth background, and that's a very important principle in the merging and successful integration of two companies, one Australian, the other one North American, with assets in Turkey. And then secondly, since the merger, that rapid growth is continuing, and that is our vision and strategy going forward. Just a final point, would like to refer to the company identifying environmental factors in these countries where we operate, especially Turkey. We've identified a strategic business partner in Lydia Mining. They currently own 5% of the Chipla operation with the option of acquiring another 15%. A very important role to understand national issues, to build on relationships, successful relationships with the Turkish government. So today, production is coming from 4 mines in 2 continents. The Chipla gold mine is situated in eastern Turkey, whereas here in Australia, in the eastern goldfields, we produce from 60,000 ounces a year from the Fox Lakes underground mine, 40,000 ounces from the South Kalgoorlie operations, and 170,000 ounces from the Higginsville operations. Deliverables since the merger in February, 91,000 ounces in our first quarter together. Reserve increases to 5.5 million contained ounces, and also announcing commercial levels of production at the Chipla operations in eastern Turkey. Chipla gold mine is essentially an open pit heap leach operation. The first gold pour this year will stack 6 million tonnes at a 2.1 strip ratio. The first gold pour was in December this year, and in March of this year we produced 17,000 ounces, so a very successful, very steep ramp up, producing 33,000 ounces in that first quarter. Therefore, we announced commercial levels of production at the end of the quarter, 1st of April. However, the future here is in using the primary secondary crushing circuit, which is currently was under construction. It's now completed, and first half of June we will commission the crushing, agglomeration and stacking circuit. This mine generates cash. It has the potential to be a company builder, and for that reason we've turned on 5 exploration drill rigs. To date we've drilled about 15,000 metres. It's also important to know that we'll use Chipla as a base to expand our operations in the Greater Turkey. To deliver the 800,000 ounces by 2014, we've identified 2 step change projects. The first of those are the Chipla sulphide expansion project. Recently we announced the results of the pre-feasibility study, and through the study increased our reserves to 4.6 million ounces. We're essentially looking at producing 3.7 million ounces over the next 16 years from both the heap leach and the pressure oxidation plant. The financials are listed there, essentially huge potential to generate cash. We've done this project at $1,048 per ounce. Huge upside. Here in Australia, the Higginsville operations, the Trident underground mine, a mine that produces between 900,000 and 1 million tonnes per year, still the flagship in Australia, 3rd largest underground gold mine in Australia. However, we're now developing Higginsville as a multi-mine operation. Recently started the Vine open pit, which will be with us for at least the next year. We've also started dewatering and rehabilitation of the Challenge open pit, Chalice underground mine. The Chalice underground mine will give us the potential, the opportunity to take gold production at Higginsville up towards 190,000 to 200,000 ounces over the next 2 years. Our geologists have an excellent understanding of the Trident ore body. Today we're drilling 2 surface rigs, basically intersecting the ore body at 1 kilometre below surface, those lower points on the slide. We're also drilling 2 underground rigs into the Apollo North Lode. So this year's resource extensions will come from the Apollo North Lode and also come from depth extensions to the Artemis structure. Basically seeing similar high-grade narrow intersections as we saw shallow in the Athena lodes, and also seeing thick high-grade intersections as we saw shallow in the mine in the western zones. A year ago, we acquired the South Kalgoorlie operations from Dioro Exploration, a 1.2 million tonne plant, huge exploration potential, and 49% of the Fox Lakes underground mine. Our immediate objective was to extend the reserves to the current 1.2 million tonne plant. That's successfully delivered. The future here will be our second step change project, delivering 15 million tonnes to a new plant, 2.4 million tonne plant. Frogs Legs, operated by La Mancha, probably one of the highest grade underground mines in the Goldfields. In conclusion, Alaska today is drilling 15 rigs around the world, 5 in Turkey, a 3-tier approach, and in Australia we're drilling 10 rigs between Norseman and Kalgoorlie, a very highly endowed area and a very good pipeline, brownfields, greenfields and extensions to the current operations. So going forward, our commitment is to deliver 800,000 ounces by 2015. We're currently focusing on safe production. However, going forward, we need to also invest in developing capacity within our workforce to deliver 800,000 ounces by 2015 while the world is changing around us. Thank you very much.
Thanks, sir. Thank you very much. And I'd like to introduce Ian Levy from Australian Bauxite. Take it away, Ian.
Thank you very much, and welcome to Broken Hill for a group of our investors, and I'm very pleased to see you here. Australian Bauxite Limited is an emerging explorer moving towards production. Our ASX code is ABZ, and for those who aren't aware of it, bauxite is the ore for aluminium. There's the usual disclaimer. Our mission is to export bauxite from Eastern Australia into Asia, particularly China, and into India. They're the two growing demand areas for bauxite. There's a transformation going on in the bauxite industry that most people have not noticed. Bauxite and aluminium will follow iron ore as communities move more towards consumer items and into vehicles and into households. Our second mission is also to sell some of our bauxite here in Australia into Australia's very large aluminium industry. There's been no new bauxite mines in Australia for more than 30 years, and it is time to start expanding now, and we hope to be the first cab off the rank. I've put a very detailed slide here for people who want a copy of this presentation, but our shares have risen from 20 cents to a trading range of 60 to 70 cents now, and we hope to continue that trend on in the second half of this year and well into next year, which looks like being a very good year for us. Our key employee is in fact our Chief Geologist and Executive Director, Jacob Rebeck, and many people at this conference recall Jacob from his years as being Chief Geologist for CRA and Rio for many years, and we're very proud to have him, a person of his calibre, in our company. Our business overview is that we've got 2 projects now moving into the pre-feasibility study stage, hoping to commence production in 2014 if all of the political will flows our way. We've got 34 tenements, 34 major bauxite occurrences. We discovered 80 deposits, but we rejected 50 of them on the grounds that they were in landscapes that were unlikely to be mined in the next century. So we've kept the best 30 for us. We're drilling thousands of drill holes, and our peers, our competitors in the junior bauxite space are currently blocked by socio-environmental problems that are, touch wood, not a problem for this company at this stage. We've got about 7.6 million in the bank, and we spend at about 3.6 million per annum. So we're fully funded for 2 years, and we have no plans for any capital placements. For those who are not into the details, 5 tonnes of bauxite is refined into alumina at a bauxite refinery, alumina refinery, which is then smelted at these major smelters into aluminium metal, which then goes into manufacturing items. I've got beer cans there to suit the audience, but it could equally be an aircraft, it could be an electric power line, and it also could be a set of aluminium windows. Where it all is happening, Australia and Indonesia are going to be the suppliers, the main suppliers into China. China and India are going to be the main refiners into alumina. and Russia, China, India, the Middle East and Iceland will be the main areas where there's cheap electricity to manufacture the aluminium metal. And our three ways to success is mainly to start exporting bauxite itself. This is the key diagram. It's hot off the press. It's got some information that's just arrived from China today. There are two graphs. The top graph is the trend line in world bauxite prices. It's very hard to get these prices, but they do exist now. And there's been a general upward trend since the beginning of 2005. Australian bauxite gets a premium because it's a reliable product. It's been very well managed by CRA and Rio over the years. In the bottom graph, it's a graph dating from beginning of 2005 through to the present, and it measures the imports of bauxite into China in thousands of tonnes per month. Now, if you look to the very right of that graph, you'll see a red bar, which is today's new news, that China's imports of bauxite have risen 16% in 1 month to an all-time record of 4.14 million tonnes in a month, and it is continuing the trend that is the basic underlying business principle of this company, that China will import less alumina and much more bauxite going forward in the future. The reason for that, China built the world's largest alumina refining capacity, and they're going to use it. And we are going to supply them with the bauxite. So seaborne trade of bauxite will do what happened to seaborne trade of iron ore 5 years ago. It's going to grow very strongly. We've got projects stretching from central Queensland, just south of Gladstone, all the way to Tasmania, of all places. There's bauxite all the way through. We've got bauxite up in Queensland that is a very high quality deposit, would be wonderful feed into the Gladstone refineries, and I need the railway lines upgraded by the Queensland government, so we're in negotiations about doing that. Our second big project is likely to be the first one to get into production, and that's around Goulburn in southern New South Wales, right on the main railway line leading to Port Kembla, which is an export port, and we've already discovered more than 35 million tonnes target in that area. We've now got 25 million tonnes in JORC resources, and we're still drilling today. Our total resources for the company are 60 million tonnes, mainly 35 million tonnes located in northern New South Wales. That's a long-term big project that we won't talk about today. And we've also got Tasmania coming along, and again, that's a long-term project. You have to do things slow and steady in Tasmania. The binge ore deposits are amongst the highest grade bauxite found in Australia's history. It is quite remarkable material, and it is very low in silica, which is the main contaminant, very high in alumina, and it is ideal feed material into the sweetener circuits of the Gladstone refineries. It's also in high demand internationally for exactly the same purpose. The Taralga resources, we've just recently announced a doubling of the resource base there to 25 million tonnes, and that resource base around the city of Goulburn will continue to grow. And we've discovered new bauxite occurrences halfway between Goulburn and Port Kembla at Wingelow, and we're currently drilling on that at the moment. So it's likely to be the first one and the easiest one to bring into production, and we are in negotiations with potential customers. I won't dwell on the geology too much, other than to say this was an area of bauxite that was discovered after World War II in very small locations. We've extended that discovery massively over a larger area, and the reason it hasn't been explored since 1954 was that the discovery of Weipa and the Darling Ranges in Western Australia just meant that us geologists just thought we'd found it all, we didn't need to go looking. But China has changed all that, and we dramatically do need to find more bauxite, and we are finding more bauxite. Finally, I've been very pleased that there's a lot of metallurgists at this conference. I'm getting a lot of metallurgical advice. The ore is a mixed ore type. You'll see this is a photo of our typical ore It's a mixture of very light-coloured bauxite, which is premium grade, mixed with a mid-grade red bauxite, and we're trying to work out how to separate those two into two different products for two different customers at very different prices. So the idea is to learn how to get every inch of value out of our deposit, and we're working on that. Our Port Kembla gateway to the future and to the world markets is an underutilised port with massive excess capacity, and there is also an old copper smelter there that if someone wants to do any upgrading, they may well have an ideal industrial site there. Finally, the key to our success has been one and only thing, our excellent landholder relations. We spend a lot of time, we take a lot of care about it, and we do respect the farmers on whose land we one day want to mine a paddock or two. It's generally the poorer ground that has bauxite. Bauxite is a very infertile rock, and so landholder relations are the key to our business. And finally, why do we want to mine in Australia rather than in the tropical rainforest in Indonesia? The reason is we in Australia actually do the mining and the rehabilitation better than anybody else in the world, and we should be very proud of our environmental engineering heritage. Thank you very much.
Thanks very much, Ian. Some good points there. Graham Ascouugh now for Mithril Resources. Graham's the Managing Director there.
Thanks very much, Nick. Good morning, everybody. 2011 is shaping up to be a really exciting year for Mithril Resources. We have 2 drills turning on our flagship project. That's our Huckata project located in the Northern Territory. We have a new copper discovery at Huckata, a new and growing copper discovery called the Basil Prospect. And I'll go through Huckata in some detail today, but it's really just a snapshot in the time that we have in front of us. We've recently spun off our South Australian tenements, and that was a successful IPO. Musgrave Minerals listed in April 2011 after raising $20 million on a greenfield exploration place. That was a good news story. We've got 2 significant projects in Western Australia, our East Pilbara project and our Sandstone project, both targeting nickel sulfide mineralization. I won't have time to go into those projects today. Just while we're on this slide, it's a very busy slide. We are a relatively small company, a market cap of $28.5 million. We do have $12 million of cash on hand, so we do have the money to go out and chase that high-quality pipeline of targets that we have in front of us, and I think that'll come through in the presentation today on our Huckata project. So Huckata is located just outside of Alice Springs. It's about 140 kilometres east-northeast of Alice. We've acquired quite a land holding in the area, some 5,500 square kilometres of tenements that we hold in our own name. Those are the red tenements, and those that we hold in joint ventures where we either have a 60% interest or we're earning an 80% interest. Now, if you looked at this map 2 years ago, there would have been one small copper occurrence on it. So for whatever reason, this area was unloved and unexplored. We think it's quite prospective. Initially, we targeted this region on conceptual principles for nickel copper sulfides. It had the right geodynamics, the right host rocks for nickel copper sulfides, and that exploration effort was validated through the discovery of Blackadder and Baldrick. But in the process of following up the nickel targets, we identified a large hydrothermal copper system, our Basil copper trend, and it's over 10 kilometres long and it's at surface. I've gone through most of these bullets already on the last slide, but I wanted to emphasize that we do have an extensive drilling program underway. We've completed about 3,500 metres to date. The market is waiting for assays to come out. We're very keen to get them out, and as soon as we get them in hand, we will make an update to the market on the progress of that drilling. So just to focus in on the Basil copper prospect, again, it's 10 kilometres long. It's mineralization at surface, so we're seeing gaussons at surface. This slide focuses on the bottom 4 kilometres, where we've done the bulk of our drilling to date. Prior to 2011, we drilled about 4,000 metres, testing about 2 kilometres of strike on the Basil trend. You can see some of the grades that we're getting there, 40 metres of 0.6, roughly 60 metres of 0.6% copper. All of the drilling is kind of from surface to 200 metres vertical depth. I don't have the depths here, but I'm happy to provide further details at the booth. This is a large mineralizing system. It pinches and swells, it gets very narrow in places, but it blows out to over 146 meters of width in places as well, and the widths that you see here are generally true widths. This year we're focusing on extending our drill footprint to date at the Basel prospect, so we're looking at extending it to the southeast, testing a number of geophysical targets, conductors and gravity anomalies, again near surface, and looking at extending it to the northwest as well. So if you stood on the last drill hole in the northwest corner of this slide and looked to the north, the Gaussian that reflects the weathered portion of the mineralization at surface, we've mapped that Gaussian for another 8 kilometers of strike, and we're just starting to march north. So this system looks very, very big, and it's got us very excited. It's all semi-massive sulfides as well, and that's the image that you see in the lower right-hand corner. So the Basel prospect is one of just a number of prospects that we have on our property position. This is a satellite image just zooming into the central portion of the Ascouugh project. I've plotted up the rock chips on this slide and colored them up by copper grade. You can see that 10-kilometer long basal trend standing out. A long strike from that, or along the same structure, we have the Manuel prospect, and that's another area that we're going to be drilling this year. At Manuel, we're seeing high-grade copper mineralization over narrow intervals, and I'll go through that in just a minute. And then we have a number of other copper, nickel, and gold anomalies to follow up as well. So Manuel, about 5 kilometers to the east of Basel. We've completed a handful of drill holes at Manuel to date. We've intersected narrow intervals, 0.3, 0.2 meters of 3 and 4% copper, opposite of Basel where we have large intervals of low grade. We do see potential for thickening at this zone. These are massive sulfide breccias that we're intersecting. They've clearly been remobilized from what we hope is a potentially larger source. We've completed some ground geophysics in the area in April this year. We've developed some high conductance targets in the vicinity of the drilling that we've completed to date, so we need to get out there and follow that up, and we'll do that in July and August of this year. So quite an extensive drill program planned between the Basel and the Manuel copper prospects. 10,000 meters all up is what we have budgeted to date. We also have an Air Corps RC rig on site at present testing 22 regional targets. These are nickel targets, gold targets, and some other copper targets as well. That's all progressing very well. To give you an idea of the prospectivity of this project area, we continue to find new mineralization at surface all the time. And in fact, in November last year, we identified the Tibbs gold prospect, and this is one of the more exciting gold prospects I've seen of late. It's a Gaussian again at surface at the contact of a marble and the underlying country rock, the felsic gneiss. Chip sampling across the width of that Gaussian, we're getting up to 6 grams per ton gold. Mapping it along strike, we've now mapped anomalous gold at that contact for 3 kilometers of strike, so it looks like it's got some scale to it. And we've had grab samples come back with up to 13 grams per ton gold. So that's an exciting play. We've done a couple of lines of Air Corps traverses, shows shallow reconnaissance drilling on this prospect to date. We're waiting for those assay results to come in, and we'll use that information to vector the next round of drilling on the Tibbs prospect. We've got a couple of other gold projects that I won't go into today because of the limited time. But again, we're seeing up to, on Yoda to the north, we're seeing up to 20 grams gold at surface, so quite exciting numbers. As recently as March of this year, we identified a new mineralization style on the project area well to the south of where we've been active to date at Basel and at Tibbs. This came through the NTGS, the Northern Territory Geological Survey, who were out doing some regional mapping, and they identified a widespread hematite fluorite alteration system with a bit of sulfides, a bit of chalcopyrite, a bit of pyrite around that's consistent with, we believe, an IOCG, an iron oxide copper gold system. We followed that up in April. I'll show you a slide of the rocks in just a minute. But what we're seeing is some intensely altered, actually I'll show them to you now, intensely altered brecciated granites with hematite veins throughout, some minor sulfides noted, generally pyrite, hematite breccias with fluorite veining. It's all relatively consistent with an IOCG mineralizing system. We've just completed a gravity survey. We've come back with some really compelling anomalies. There are mafics in the area, so there's the potential for false sources of anomalies, but these are the things that we've got to get out and test. We have completed regional soil geochemistry. We're not dealing with a lot of cover here, generally a couple of meters up to 10 or 20 meters. So if these come back with some geochem highs on them, then they're clear targets that we'll get in drill test as a priority. Just quickly to finish up, I said that the project started as a conceptual nickel play. We've validated those targets. We've only done a handful of holes on the nickel potential. Baldrick, we had 9 meters of 0.5% nickel and sulfides with a bit of copper as well. One of the nickel targets that we're quite excited about is Gertrude. We've got a small mafic body. We've got a Gaussian that's 50 meters long. It's anomalous in nickel, copper, and PGEs, and we've got a very compelling VTIM anomaly that's just come in on the recent results. So this is a coincident mineralization and EM anomaly that would suggest that mineralization continues at depth. So there's a drill target that we have in front of us that we need to test. So that's a snapshot of our Huckata project. It is our flagship project. It's where we're going to focus over the next 12 to 24 months. We have an extensive drilling program underway. The diamond rig will be there from now till roughly the end of December. The air core rig will come and go as we test targets and wait on results. We believe we're onto a new emerging mineral province, an area that really hasn't been looked at in Central Australia. We're not dealing with cover here. The mineralization is coming right to surface in most cases. So I think we're well positioned for growth going forward. We've got a great management team, a great exploration team at hand, strong cash position, and a strong shareholder base. So with that, thank you very much for your time.
Thanks, Graham. I think you'd have to get an award for the best names of projects so far, but it's good. So I'd like to bring Dr. Russell Penny now, who's going to talk about UXA Resources. Thanks, Russell.
Thank you. Good afternoon, ladies and gentlemen. UXA Resources, these are the legal statements which you'll find on our website, and the ASX release of this presentation went out this morning, so I won't have time to go into great detail, obviously, in the time I've got available. Our capital structure currently is that we have 348.7 million shares on issue, market cap of around 10 million. We have recently raised 1.1 million by issuing new shares. We're a little bit different to some of the other junior exploration companies around because we also have a cash flow business, which is a borehole wireline company that we purchased in 2009, and we've been expanding since. Our exploration portfolio has expanded in the last year and encompasses a number of base metal projects as well as the uranium projects that we've had for some time. We've got a number of important joint venture partners, including Teck, that's a major Canadian company, PlatSearch, Straits Resources, and a joint venture in Northern Territory with Reliance Industries, which is one of the biggest listed companies in the world. Today I'm going to talk about two things. I'm going to talk about some drilling that we're doing less than 50 kilometres from here out on the Mundy Plains on basically a new discovery that was made by Teck and PlatSearch back in 2007. I'll also talk about our borehole logging division. So out on the Mundy Plains there's a rig turning at the moment, or probably actually isn't because of the rain today, but essentially, there's at the base of the Adelaidean sequence, there was a discovery made of Mississippi Valley type zinc lead mineralization, and it's down at about 320 meters depth. We have an option agreement with Teck to earn into the joint venture that they have with PlatSearch. Essentially, our rights are to the basement rocks, that's the Proterozoic rocks, and Teck and PlatSearch have rights to the surface rocks and also some clawback rights. The location is absolutely fantastic from the point of view of making a lead-zinc discovery or any future development. The ground holding that we have consists of 8 granted tenements, also straddling the border over into South Australia. The area is prospective not only for the MVT deposits I'm going to talk about, but also potentially for iron oxide copper gold in the southern part of the tenement holding, And of course we're in good company with Ascouugh and a few other deposits off to the west there in South Australia. This is what the mineralisation looks like. We have a number of pieces of core on our stand which you can come and have a look at. Essentially it's very typical Mississippi Valley or Irish-style lead zinc mineralisation. There's pale, honey yellow sphalerite, which means it's got low iron and would produce a very nice concentrate. You can see there's some purple, that's fluorite. There's fluorite veins. Those are also very typical of MVT systems. There's also some very coarse-grained galena in places, but most of the mineralisation we found so far is sphalerite. This is a plan of geological interpretation down at about 300 metres below surface. The project's called Dome 5 because essentially there is a geophysical dome which is a granite, and that's both a magnetic and a gravity anomaly. And that dome has the basal part of the Adelaidean sequence onlapping onto it. The holes there, the white holes, are the holes that were drilled by Teck in 2007, and essentially all 5 holes in a 1 kilometre area discovered MVT mineralisation. We're currently engaged in a 7-hole drilling program, of which we've drilled 5 holes so far, and I've announced results from the first hole so far, which is DF9 there, where we've got a 3-metre intersection with about 3% zinc and 0.5% lead. There are some much higher grade narrow intersections in the original drilling that Teck did, with up to about 25% lead zinc with some silver. So as I said, we've got the 7-hole program, and we're slowly stepping out as well as infilling the pattern of drilling that's there. The closest hole, the holes are still 250 metres apart in that pattern there. So if we look at the cross-section, if we just go back, you'll see that there's a section line AB which is running in a southwest-northeast direction. This is what it looks like in cross-section. So you've got the red there showing the granite, which is essentially a physical dome, and then there's Paragon group metasediments in the blue with the folding shown. There's an unconformity with a very, very typical sort of sequence that you find carbonate-hosted lead zinc deposits in, a non-lapping sequence which has got clastics at the base, the Angiopenna formation. Those are actually red beds which very rapidly turn into a grey limestone sequence. That sequence has fine micritic limestones, but also peloidal or oolitic type limestones, and those are the limestones that contain replacement style lead zinc mineralisation. There's also vein style mineralisation which cuts through the limestone sequence. As we go out to the southwest, there's a slight increase in thickness of the clastic wedge, and there's an interpreted fault position shown there. We expect that there'll probably be quite a few growth faults within this. And of course, this is the most comprehensive section we have at the moment, going northeast-southwest, and we're not quite sure what's happening in the other dimension yet. So, as I said, the closest together those holes are at the moment is about 250 metres. So we've got a mineralising system that's over a kilometre in that dimension, and we're yet to see how big it is in the other dimension. The stratigraphy, for those of you who are familiar, this is South Australian terminology. Essentially, we're looking at this carbonate unit, which is part of the Adelaidean sequence that's onlapping onto the much older Mesoproterozoic dome. As I mentioned before, we also have, we believe, potential here to find copper-gold mineralisation of the type that's been found in the Curnamona province, such as Ascouugh, which you heard about this morning from Havilah. This is a magnetic image. There are a lot of magnetic features in there that we know represent folding of the Bimba horizon and a lot of the sequence below that. The stars on this map indicate what we believe was a whole host of geophysical targets for both domes that might have further buried MVT mineralisation and for the copper-gold mineralisation. This ground has also got some untested airborne EM signatures from older surveys done by BHP many years ago. The cover rocks, the tertiary cover rocks, which you saw on the section, get thinner as you go to the south. So in the southern part of that block, we believe that the cover sediments over the prospective rocks is only about 50 meters. GA wireline, I'll very quickly go on. We own the prompt fission neutron device, which is a unique uranium finding tool. We recently moved into the United States. We have some major new contracts with Cameco and with Peninsula in Wyoming, which is, of course, one of the major sandstone-hosted provinces of the world. The PFN device is ideally suited to this, and we see a lot of growth potential. I won't talk about our uranium projects. They're in Northern Territory and Western Australia, and so that basically takes us to the end of the very brief presentation. Thank you.
Thank you very much, Russell. Thanks very much, Russell. And now I'll introduce Bernard Rowe, who's with Global Geoscience. If you could take us to the last presentation, mate, if you could.
I will do. Thank you, Nick, and good afternoon, ladies and gentlemen. I'm going to tell you a little bit about Global Geoscience. We're a copper-gold explorer with a project focus in Nevada and Peru. A disclaimer there for you to read at your leisure. Okay, just a brief snapshot of the company. As I said, we're focused on copper-gold exploration. We're targeting large, high-value deposits. I guess we're a little different than some other explorers. We think so anyway, in that we regard ourselves as finder explorers. And what we mean by that is that we're actually out there doing grassroots exploration, and what makes us a little different is that we use an in-house targeting method to select areas that we think are interesting. We look at and see if they are free or held. If they're free, we get out and investigate them on the ground doing traditional exploration. If they're held by somebody else, we will go and talk to them and try and get access to the ground. A benefit, I guess, of doing that approach of grassroots greenfields exploration is that you often end up with 100% ownership of your projects, which we do have. We've worked up many of these now, and several of them have got drill-ready targets on them. We're a company that spends the majority of our funds on exploration. We're four in every $5 for the last several years has been spent in ground. And I guess an important thing is that we have drill programs upcoming in the next few months. Board and management, Rob Reynolds is our chairman, Patrick Elliott's the other non-executive director, Peter Nicholson and myself are the two technical executive people, and we're both here at this conference if you want to talk to us later on. Okay, quick profile. Listed in December 2007, we have 129 million shares on issue, 30 million options at 25 cents. 45% of the company is owned by the top 20, and that's remained quite constant since we listed. 14% is owned by the directors. The market cap of current share price of 5 cents is 6.4 million, and we have cash of 2.1. Okay, just looking at Nevada firstly. A reason that or some of the reasons we went there, the main reasons we went there, is the metal endowment. That map shows the state of Nevada. The yellow dots represent gold deposits that are larger than 1 million ounces, both mined and contained resource and reserves remaining. We're talking about an area that's about a third the size of New South Wales when you look at the state of Nevada, so an incredible number of large deposits. In amongst those million ounce deposits, you've got things like the Carlin Trend, which collectively represents about 67 million ounces of gold. The Walker Lane has produced something like 20 million ounces over its history. Nevada ranks as number 5 in the world for gold production. The current resources are estimated at about 70 million ounces. It's a great place to work, it's very favourable, and I'll leave you to look at those things in your leisure. A couple of projects in Nevada that I'll show you. Excelsior Springs, which is in the southern part of Nevada in the Walker Lane. This map shows a zone of alteration and mineralisation in pink. That map shows an area of about 3 kilometres in an east-west direction. So there's a 3 kilometre long mineralised zone in altered limestones and limey sediments. There's about 200 or 300 metres of that has been drill tested by previous explorers in the Buster zone, which is in the sort of the central part of that map. We picked this project up very recently, and straight away we saw that whilst there had been the drilling targeting that immediate area around some old mine workings, the rest of the zone had been completely untouched. No systematic stream or soil geochemistry, rock chip sampling, mapping, no ground geophysics. So that's what we've been doing over the last few months. That whole zone is currently being covered by an IP survey, which is about halfway complete now. And once we've done that, we plan to drill test here in the next couple of months. Already we've defined a couple of new zones that are 300-400 metre long zones with numerous rock chips on surface of between 1 and 5 grams per tonne, with some other interesting chemistry as well, high molybdenum, bismuth, copper, completely untested. The eastern half of that map is largely exposed, so there's good outcrop. The western half is underneath 1 or 2 metres of alluvial cover, so anything out there has never been touched. We are earning a 70% interest in this project by spending $3 million over 4 years with $100,000 in cash. I'll just show you a couple of maps in the next few slides which just come from that one Buster zone area, so 300 or so metres along strike length right in the centre of that map. What you see here in the top map is a plan view of the zone, so representing about 400 metres of length. You can see in pink the east-west or sort of trend of the major structure, and in the other colours, the red, green, blue and black, are zones of probably dilational zones that have opened up and the mineralising fluids have passed along them, and really that's the zones that carry the gold grades that we're interested in. Below that is a long section which shows the same zones with the same colour scheme. The blue and the black, I guess, shoots are the ones that have had a few drill holes in them, and they're coming up with things like between 20 and 40 metres wide horizontal width of between 1 and 2 grams gold. The other two shoots, the red and the green, have only had 1 or 2 holes into them, and they've also had encouraging results. That's all down to less than 100 metres depth. It's all oxidised, and it's all a few kilometres from a bitumen road. I guess you could say that in terms of target size there, each of those shoots has a strike length, as shown on the map, of about 100 metres. So there's 4 of them. We're talking about 400 metres long, average of about 20 metres horizontal width, down to 100 metres depth would give you something like 2 million tonnes at somewhere between 1 and 2 grams gold just for that zone alone. And all of those shoots are open to the northeast and also at depth. Obviously, that represents an interesting drill target for us, but also these other zones which are completely untested are something that we're equally going to be focusing on in this drill program as we ramp that up in the next month or so. Actually, that's a cross-section, and it was drawn through the central part of the blue zone of the previous map, so you can see that those shoots are dipping at a sort of a 60-degree or so angle to the south, and you can see some of the grades and widths, 26 metres at 1.1, all oxidised. Okay, Bartlett Peak is another Nevada project. It's located in the northwestern part of Nevada. It's a porphyry copper gold target, 8 square kilometres of area, 100% owned, excellent access. There's a zone that we've defined there of 1,000 metres by 400 metres of strong sericite alteration with strongly anomalous copper and gold. Never been drilled. We're doing an IP survey there in the next few weeks, and we've got our permits in place to drill. I won't talk about that's another early stage target Nevada. But in Peru, I'm just going to show you one very quick project area in Peru, great metal endowment like Nevada. Sara is a porphyry copper play. There's a large advanced argillic alteration lithocap that we've shown there. We've drilled some holes into it, got some strongly anomalous copper and moly in the top few hundred metres. There's a porphyry copper target at depth that we haven't tested, and we've had some high-grade silver hits like 16 metres at 400 grams in the lithocap above the porphyry. So the porphyry is quite deep there, greater than 800 metres is the deepest hole we've drilled to date, and that target lies below that. The silver target's much closer to the surface, 200 metres, and is open in all directions. Okay, so just in summary, we're doing IP surveys at Excelsior Springs as we speak. We'll be doing the same in Bartlett Peak in May and June in Nevada. We're trenching and RC drilling at Excelsior in June, July this year. We're doing geochemical mapping and sampling to try and bring our Dun Glen project up to drill-ready stage. We plan to RC drill at Bartlett Peak in July, August once we've finished the IP. And then later in the year we'll be follow-up drilling at Excelsior and also testing that high-grade silver in Peru. So thank you very much.